So good afternoon, everyone. Welcome to this corporation tax webinar, where we are going to aim to go over some of the main topical tax issues that are facing companies right now. We'll cover a range of different scenarios, and hopefully you'll all find something there that's useful to you. Just to introduce myself, my name is Joe Wilson, and I'm one of the tax managers at HWB. Just a bit of background about myself. I've been working in tax for 15 years and I qualified as a member of the Chartered Institute of Taxation just over 11 years ago. My day-to-day work mainly focuses on tax issues that affect owner-managed businesses and individuals. So that'll be mainly dealing with personal tax issues and corporation tax issues and how the two interact with each other. So just before we get going, just a couple of housekeeping rules. Just to mention that this webinar is being recorded and we will be running Slido for this because there will be a few polls, which would be grateful if you could please use when prompted. And in order to join us Slido, just please use your phone to scan the QR code that's just appeared on the screen, or if you prefer, and log in at slido.com using the number on the screen. Just to as I mentioned, this webinar is being recorded and it will be uploaded on YouTube in the next week or so. So if you want to view it again, so I'll just give you a few moments to enter into Slido, and then we'll start the presentation. Okay, so if we bring up the agenda, the presentation today is going to be broken down into 4 sections. The first is going to focus on remuneration planning and what that means for business owners and capital gains tax considerations when they look to sell or leave their business. Then I'm just going to go over some topical issues that affect a company's corporation tax liability and ways that can be mitigated and how various factors have an effect on that. Then we are going to go over some corporation tax reliefs that are available to companies that not everyone may necessarily be aware of. And we're going to finish with some potential pitfalls and areas to watch out for in corporation tax. Now, the purpose of this presentation is to be interactive, and we do have a chat on the side, and if you just want to answer a question at any time, please type your question into the chat, and when I get to the end of a section I will aim to answer as many questions as I can, but if I'm not able to answer your question, we'll aim to get back to you after this presentation's finished. So moving ahead into the first section, which is remuneration planning. This is topical because recent messages by the government have brought this area into a lot more focus. In this section, we will be looking at factors that need to be considered when withdrawing money from a company and what is the most suitable way for this to be structured. In addition, we will also see how tax-efficient benefits and other rewards can be used as a useful planning tool for the business owners and as a key way to incentivize their staff. And finally, a lot of business owners sometimes make use of company vehicles for private purposes. Understanding the income tax implications of this is very important, especially given that there have been some recent key changes in this area that may have slipped under the radar given all the other tax changes that have come in recently. So if we move on to the next slide, we're going on to remuneration planning, and this question has often been asked by business owners on an annual basis. And that question is, should I take remuneration from my company by way of a salary or a dividend or a combination of the two? Now, previously, and it was long-established practice, we would commonly see company owners pay themselves a small salary of around £10,000 to £12,000 and pay the remainder of their remuneration in dividends. And the strategy was adopted as the small salary helped ensure that the individual obtained a qualifying year for state benefit purposes. And furthermore, paying the rest in dividends helped ensure that the individual's take-home pay would be greater than using the other option, as dividends were taxed at a much lower rate than salaries previously. However, recent changes that have come in the last budget and the last couple of years have meant that this is no longer such a straightforward answer, and there is no real one-size-fits-all solution. In the last budget, there was a massive change that affects directors' salaries. To put this into a bit of context, previously, directors would be awarded salaries above something called the lower earnings limit for national insurance purposes. And this ensured that an individual could obtain a qualifying year for national insurance or state benefit purposes without paying any NIC. And this is always very important because to be entitled to a full state pension, an individual will need 35 full qualifying years for national insurance purposes. If only dividends were awarded, a qualifying year would never be obtained. A qualifying year can only be obtained in this situation on a salary payment, which is made above something called the lower earnings threshold. However, in the last budget, the secondary NIC rate, which is the level employers have to start paying national insurance on wages, fell all the way down to £5,000. And this is below the lower earnings limit of 6,500. And when we think that the NIC rate increased to 15%, it's quite a significant change. This means that for the first time in a long time, employers have to pay national insurance on directors' salaries in order for that director to obtain a qualifying full year for state benefit purposes. So if they want to pay 6,500, there's going to have to be a national insurance charge of £225. Now, another factor that needs to be considered in remuneration planning is how does the remuneration awarded affect the company? Because quite often owner-managed businesses and their owners are concerned about not just the tax savings for themselves, but for their company. And salary payments, unlike dividends, are eligible for corporation tax relief. And the rate of corporation tax relief for most companies is now 25%. And this has a much bigger influence on decision making as part of the pay package compared to a few years ago, when a maximum rate of corporation tax would be deductible on these salaries was 19%. Also, given that the gap on income tax rates on salary payments and dividends has now narrowed over the years, and the other factors I've mentioned, the decision on how a business owner is rewarded from their company is not so obvious and clear-cut now. In fact, in some scenarios, using salary or dividends, the overall difference is non-existent, or even in favour of a full salary payment in some circumstances. The thing we need to take away from this is really that each situation needs to be reviewed on a case-by-case basis, as the following considerations that I'm going to have listed must be accounted for when deciding the remuneration strategy. So, for example, what some business owners have property or other investment income outside of their company, which can influence their decision making because that affects what tax bands this income falls within. What level of income does the business owner want to require to live on? They may not wish to take all the money out of the company they've earned in a particular year. How much does a business owner want to consider the overall tax effect to the company? And are qualifying years still required for state benefit purposes? It may well be that when an individual or a business owner has checked their online government gateway account, they may already have found they've obtained the full 35 years and no more qualifying years are needed. So as I mentioned, the key thing to take away is that there is no easy answer, and we would always recommend remuneration planning is undertaken to ensure that this is done on the most efficient basis to meet the business owner's circumstances and needs. So now we're going to go into our next slide, which is the Slido, and just give you a few moments to answer this question. Do you as a business owner have a pre-year-end tax planning meeting with your advisors? So if you just enter this, and we'll see what the common consensus is. So I can see from this poll here that the common consensus is most people don't have a year-end tax planning. We would at HWB offer this and advise this where possible, because circumstances change, tax rules and tax rates change, and what was right for one year may not be right for the next year. So please do come and speak to us on a year-by-year basis to ensure what is being done is most suitable for you. Thank you. So if we move into the next slide, which is going to be talking about capital gains tax considerations. And this really is when a business owner looks to exit the business for capital gains tax purposes. And what will the tax be due on the sale of their shares or when the company's wound up or liquidated? And in this area, there was a key change because in the last budget, the rates of capital gains tax increased during the tax year, which hasn't happened for a long time. And from October last year, capital gains tax um, for basic rate taxpayers increased to 18%, and for gains that fell within the higher rate tax band of an individual went up to 24%. Now, for business owners, you need to look out for the reliefs that are available, and providing certain conditions are met, business asset disposal relief can be claimed in certain circumstances, which will reduce an individual's capital gains tax bill in this scenario. Now, in short, the main conditions for this relief to be available are that the individual needs to own 5% of the business or the share capital, the company is trading, and the individual is a director or an officer of the company. And these conditions must exist for 2 years up until the date of sale. And it's crucial they are. I mean, this is just a very brief summary of the rules, and they would need to be looked into further detail. Now, the reason we want to claim this relief is that all gains that qualify for business asset disposal relief are taxed at 14% as opposed to 18% or 24%. However, the crucial thing to take away from here is to be aware that from next April, the rate of business asset disposal relief is increasing from 14 to 18%. So if you're a business owner and you are looking to wind up your business, you may want to bring it forward before next April, because as a maximum, £40,000 in capital gains tax can be saved per an individual. Now, the amount available for relief for an individual is capped at £1 million during their lifetime. So before making any disposals or winding up your business, please make sure this is checked. When this relief was known as entrepreneurs relief, the lifetime limit was £10 million. So it's important that this is traced and we look at previous events to make sure that we are aware of the extent of the reliefs that are available to us when we are looking to sell our business. Okay, so moving on to the next slide, I just want to go over some benefits and awards, because most benefits awarded to staff and directors are tax deductible for a company when working out its corporation tax profits. And certain benefits, if planned correctly, can also be very efficient from an income tax perspective. A question that I've been asked a lot about over the last couple of years is trivial benefits. And you may ask, what's that? And trivial benefits is a little provision brought in from the government that allow non-cash gifts of up to £50 to be made to a staff member free of tax. So the company will get a deduction and the income and the individual receiving the benefit will not be taxed. The value of this is tax-free, and there is no limit of the number of times that this can be awarded in a tax year. So I think this is the aim of HMRC, not taxing people, so giving flowers on a momentous occasion or just celebrate an anniversary or whatever. But crucially, the trivial benefit cannot be in recognition of services performed. It can't be, you've done a great job on this piece of work, well done, have this reward, otherwise it will be taxable. And I would also point out that directors and their family members can only receive trivial benefits on 6 separate occasions in a tax year. So this is a valuable little reward that you may want to be aware of, that can help incentivize staff during the year. Now, another thing that I think we're seeing more people move on to this is talking about the company staff pension scheme, because we want to ask the question, is it being done through salary sacrifice? And if the pension payments made to staff or through their employment pension scheme are done through pre-tax rather than post-tax earnings, i.e. part of a salary sacrifice scheme, the staff member benefits. This is because the pension payment, the amount that's been taken from their total pay, is not subject to taxable work, is not subject to tax. So they see instant tax relief up front. And so this reduces the assessable level of income they pay to tax. And this benefits taxpayers whether in the basic or high rate tax bands, whereas other pension schemes tend to only benefit those in a higher rate band. So operating your employment pension for a salary sacrifice scheme can really benefit staff and give them a tax saving. Now, I've mentioned the word salary sacrifice, and I do want to point out that several years ago, the benefits that can be awarded from tax advantageous salary sacrifice schemes were heavily restricted by HMRC, and this is not commonly known. Salary sacrifice is not really widely available now on benefits, and it's not worth pursuing. And the only benefits that can really apply for this that be eligible for salary sacrifice now are staff pension schemes, as I mentioned, low emission cars, so 75 grams or less, payroll giving to charity, childcare vouchers, and cycle to work schemes. So just be aware of that. Salary sacrifice is much more limited. The next benefit I've got listed is staff entertainment. Now, each staff member can receive staff entertaining up to a tax-free value of £150 in a given tax year. So if I put on an event and it's worth £100, an annual event, say a Christmas party, and it's worth it works out about £100 for each staff member, then they don't pay any tax on that. It's a tax-free benefit in kind. So just be aware of that. It's also worth noting that some employers like to reward staff for long service awards, and I get asked, can I give a long service award to my staff member tax-free? The answer is yes, but the conditions are quite stringent. HMRC only allow this to be tax-free for staff who've been with the company for 20 years or more, and the benefit cannot be in a cash form, so it must be like a voucher or a gift, and the benefit value cannot exceed £50 per year of service. So you can have £1,000 for someone who's been there 20 years or more. You can say give £1,000, but it can't be a recognition of service, and it cannot be in a cash form. Now, the next thing I want to mention is directors' pension contributions, and it can be very tax efficient for a director to remunerate themselves in the form of a company pension contribution. So let's say rather than take a salary payment out this year, they want to reward themselves by paying into their pension scheme. And the reason they want to do this is because this payment is not subject to income tax, and it is fully tax deductible for the company, if it is, but providing that the pension contribution is paid before the end of the accounting period. Otherwise, tax relief is not available to the next accounting period. But strictly speaking, to be deductible, HMRC would look to see if the payment meets something called the wholly and exclusively condition, i.e. it reflects the level of duties performed. The next point I want to make comment on is bonuses. Now, of course, when these are awarded to staff or business owners, they are taxable and they are subject to income tax. But to be tax deductible for the company in the period they're awarded, the company must make the payment, actual physical payment, within 9 months of the bonus being awarded. Otherwise, tax relief will not become available until the accounting period in which the bonus is paid. In some circumstances, we can often see benefits are given to staff and unexpectedly and unwantedly, and without the business intention, the employee can get a tax charge, and the company does not want them to suffer that. And if the benefit is irregular or minor, the employer can make what's something called a pay-as-you-earn settlement agreement or PSA arrangement with HMRC, so that the employer arranges to pay the tax on the employee's behalf. Because let's say you put on a staff entertaining event and it costs £200. Your staff may not be too thrilled to attend if they realise it's going to cost them £40 or £80 in tax. If you can make that application on time, you as the employer can fit the tax bill for the staff members that attend. So that's something to consider. Now, taxable benefits are reported on a P11D form at the end of the year, or they can be done as the year goes by through payroll. Now, it was the intention of HMRC to make the payrolling of taxable benefits mandatory from next April. However, this has been pushed back to April 27. So it's open still, but it won't become mandatory until April 27. So if you haven't done so already, you may wish to payroll the company's benefits. And if you want us to do that, please let us know in good time before next April. So if we're going to go into the next slide, please, we'll have a slider just saying what benefits you and your company offer staff. So if we could just have a few suggestions or see what's there, and we can comment why this may be done and the tax impact of it. Yeah, so looking at a couple of them, I can see that medical care has come up, and that's typically a tax benefit. Now, some things to do with medical care, such as health screenings or glasses displays, can be tax-free. Opticians, yeah, which has now come up, that can, providing it relates to use of if an individual's working in using screens and it's linked to that, then if that's awarded correctly, that can be tax-free. Cycle to work, that is done by salary sacrifice and it can be tax-free as well, but providing the employee uses about half the time for commuting. Fuel cards, yeah, if that's done correctly and measured correctly, it can avoid a fuel benefit in kind benefit, but if any fuel is provided for private use, that will be taxable. Electric cars, yes, that's very topical, and I'll go into a bit more detail in the next slide why that comes up a lot. So yeah, that's interesting to know, and it's good to get an understanding of what's being offered. So some of these schemes, some of these benefits on here are taxable, and some are tax-free and very tax efficient. So if we go into the next slide, which is talking about cars and vans, which is a very topical area lately. And quite often, because the reason I want to mention this is remuneration packages can take the form of a company vehicle, and it's important this area is is fully understood, as there are significant tax consequences if this is done wrong. The main thing this all hinges on is whether the vehicle in question is a car or van, and the capital allowance treatment on these purchases is very different, more on which later, but the benefit in kind charges can vary dramatically. For instance, for private use of a van, the benefit in kind charge is a flat £4,020, whereas for a car, it can be much higher because it's based on the original vehicle list price multiplied by the CO2 multiplier, which can range from 3% for electric cars and up to 37% for the dirtiest of cars, less green cars. Crucially, if an employee or director uses a van for normal home to work commuting, that doesn't generate a benefit in kind charge. But if they use a company car for the same purpose, then that's deemed to be private use and a benefit in kind charge arises. Now, in deciding whether a vehicle is a car or a van, HMRC look at what was the original purpose of the construction of the vehicle. And if the predominant purpose of the construction is not to transport goods, then it's always deemed to be a car. So in practice, this means that if a vehicle has more than one row of seats, or the loading area is of equal size or smaller than the seating area, then HMRC are likely to judge the vehicle to be a car. If you are in doubt when you're looking to make a vehicle purchase as to what the vehicle be classed as, do let us know and show us pictures beforehand. Also, just to quickly comment, the private fuel benefit for a car is much higher than a van. For a car, it's based on a flat rate of 28,000 multiplied by the CO2 multiplier. For a van, it's just based on £769. Now, on the last slide, though, I saw that electric cars came up, and electric cars are relatively inexpensive, and they are much popular than other cars at the moment. This is because the CO2 multiplier used on an electric car is only 3%, which is very low when you consider that a car which isn't purely electric, which has a CO2 rate of 50 grams, has a multiplier of 15%, so potentially 5 times as high a benefit in kind charge. But just be warned that whilst the percentage multiplier on electric cars is low, it is increasing year on year. By 2029-30, the rate is expected to be as high as 9%. Now, the major change that's been brought in recently regarding cars and company vehicles is the treatment of double cab pickups. It used to be that these vehicles were classed as commercial vehicles if they had a payload over a ton, i.e. treated like a van, and get the favourable benefit in kind treatment and a favourable capital allowance treatment. However, from April 2025, these vehicles are now classed as cars. So this will affect all new purchases of double cab pickups purchased after April 2025. If a company already owns a double cab pickup, it will be still classed as a van or a commercial vehicle up until 2029, or if the vehicle is not disposed of this date. So that ends the end of this section. I just see there's one question that's popped up. Are pool cars a taxable benefit, whether petrol or electric? Pool cars, if they meet the strict definition of a pool car, are not taxable benefits. But be careful, the definitions of this are very strict. Pool cars cannot just be used by 1 or 2 staff members. They need to be widely available. They're designed to be left at the company's premises overnight. So if a director or an employee was consistently leaving their pool car at their own home or near their own home, that may raise doubt of whether the vehicle is actually a pool car and whether it's a tax-free benefit. Pool cars are typically used for business journeys, and that's why if they're used at kept at employee or business owner's house, it will raise doubt as whether they're actually it will indicate, sorry, that they're actually available for private use, and thus a benefit in kind charge should arise. So the next section I want to cover is corporation tax liabilities, and in this section we'll review some of the key factors that will impact the rate of corporation tax and the timing of when that corporation tax is due for a company. So if we look at the next slide, we're going to be talking about associated companies, and a major the next thing on the Slido that will help with this discussion is, can you indicate what level of profits you have? Are you making losses? Is it over the region of 1.5 million, or is it below this total? As this will help indicate where this discussion and what I'm going to comment is relevant to you. So we have one entry. Yeah, this is anonymous. So so we're seeing a range in the totals, and this is important as, yes, you may have similar rates of corporation tax due, but 1.5 million, it will affect the payment due date of corporation tax, which I'm going to now go into. And so if we bring up the first slide on associated companies, a major change in this area came in from April 2023, which affects the tax computation of companies. So prior to this, when doing the tax computation, we would review other companies that are in the same corporation tax group, i.e. when they're connected by other companies, such as a trading subsidiary or a holding company. Now, when looking at the corporation tax position of a company, this has been extended. We don't just look at companies in the same group, we look at companies under common control. What this means is that if a business owner in their individual capacity has control of 2 separate companies that are held in their name, then we count these companies in determining the rate of corporation tax due. And the number of associated companies is important as it impacts the rate of tax due. Currently, companies pay tax at 19% if their profits are below 50,000. Their profits between 50,000 and 250,000 tax due at the marginal rate, and if profits are over 250,000, corporation tax is due at 25% on their total profits. Now, crucially, if a company has, say, 2 other associated companies, these tax payment thresholds are divided by 3, so which would mean that a company, rather than paying tax at 25% on profits if their profits go over $250,000, the threshold is now 83,333. And it also, the associated companies impacts the due date of when that tax is due, but more on this later. So what is an associated company? What companies do we count? And there's some common misconceptions in this area. When counting the number of associated companies, I need to point out that we don't just look at UK companies. We also count active overseas companies in determining if the profit limits or the tax limits need to be divided. I would point out that dormant companies are not included in this count, i.e. non-active companies we do not include in the count. And this will most commonly take the form of a holding company that just receives or pays out dividends. However, be very careful to ensure that this dormant company you hold for this purpose does not start paying expenses or starts receiving other sources of income. This is because no matter how small this may be, it will become active and it will be included in the associated company count. And this raises the questions, are all associated companies required? If an associated company has little activity going on, you may wish to incorporate that activity into another company, which will mean that the thresholds for determining the rate of corporation tax is what rate of corporation tax is due, and when that tax is due for payment will be increased. Now, the next slide I want to go on is talking about quarterly instalment payments. And this is where we've seen the most impact for associated companies, particularly for those who you've mentioned your profits are over 1.5 million, or your profits are, say, hovering around that level. Because normally a company has to pay its corporation tax bill 9 months and 1 day after its year end. So if we take the example of a company with a 31st of December 25 year end, it will need to pay its corporation tax bill by the 1st of October 26. However, if a company has profits over 1.5 million, the corporation tax due date is advanced forward and becomes payable in 4 quarterly instalments. The first instalment date is due 6 months and 3 days after the start, not the beginning, of the company's accounting period, and the following payments are due in the next 3 months, with the final payment being due 3 months and 14 days after the last day of the accounting period. So you can see that the due date of corporation tax has become accelerated. So going back to our example for a company with a December 25 year end, if quarterly instalment payments are due, the tax becomes payable on the following dates: 14th of July 25, 14th of October 25, 14th of January 26, and the final instalment being due on the 14th of April 26. Now, it's important I point out that the first year a company has taxable profits over 1.5 million, it is exempt from making the instalment payments. These payments only apply in a second consecutive year of being over this limit. However, if profits are over 10 million, the first year exemption from making quarterly instalment payments does not apply. So that means that careful handling is really required for the first period of accounts that a company pays tax in quarterly instalment payments, as it will also have to consider paying its normal tax due for the previous period, 9 months and 1 day, and start paying quarterly instalment payments for the current period. So careful cash flow and planning is required. I need to point out that for very large companies, this is where profits are over 20 million, the quarterly installment due dates are brought forward by another 4 months. So with a 31st of December 25 year end, the payment due dates become 14th of March 25, 14th of June 25, 14th September 25, and 14th of December 25, which is before even the accounting period has ended. Now, going back to the associated companies of what I've talked about, is the number of associated companies is very important because it will reduce the threshold limit for determining if corporation tax is due in quarterly instalment payments or not. So if a company is deemed to have 2 other associated companies that are active, the 1.5 million instalment threshold now becomes 500,000. So if you say your profits were between around the 1 million mark, if you have another active associated company, you would probably be required to pay your corporation tax in installments. And this is a problem because companies will often have to pay corporation tax, not knowing its final taxable profit total. And HMRC do charge late payment interest on any underpayments of corporation tax. Now, the normal rate applying to late corporation tax payment is 8.5% of interest, which is quite high. But for quarterly instalment payments, when these are deemed to be paid late, because maybe you don't know what your liability is going to be and you make an estimate, the late payment interest that's charged is 7%. And I see the questions being raised, what rate of interest applies the other way around? So if you overpay in anticipation, HMRC will make repayments of tax, but they'll make the repayment rate of interest is 4.25%, which is considerably lower. So what they charge on interest does not equal the amount they pay back. So that's quite a lot there, and it shows the importance of monitoring your associated companies because it can have huge impacts on when your tax payments are due as a business. So the next slide, please. We're going to look into specific deductions that companies might want to face. I'm not going into all because there's many, this could take up hours and hours of presenting, but I just want to mention a few specific ones where we see a common questions being asked or areas of misunderstanding. The first one is when payments are made to a charity. Now, if a company makes payment to a charity and there's no trading connection or trading purpose with that, that payment is not deductible in calculating its taxable profits. However, it's classed as a qualifying charitable donation, which is deducted against the overall profits made by the company in a period. So you may ask, What's the difference? It still gets deducted anyway. And you'd be right. In most cases, the tax impact will be exactly the same. But I would just point out that unlike qualifying trade deductions, payments made to a charity cannot create or increase a corporation tax loss for the period. So there is a slight difference. The next topic I got up is bad debts, and bad debts for customers or whoever who do not make a payment are tax deductible. If you make provision for specific debtors, then you can also claim tax relief on that cost. However, if the provision you're making is general and not tied to a specific customer, this general bad debt provision is not deductible for tax purposes. Now, it is common for loans to be written off, especially between companies that are within the same group. And the effect of this is mostly tax neutral, as no tax relief is available to the company that's written off the debt. But in the same way, the borrower is not subject to income tax on the debt they've had relieved. But where care is required is where loans are written off between connected companies that are associated with each other, but they're not in the same group. This means that their common ownership is through an individual rather than another company. Where debts are written off in these cases, there is a risk that HMRC may well deem the debt that's been written off to be a taxable dividend for the business owner that controls both companies. This is because HMRC deem the funds are being transferred out of one company to another, which is in effect treated like a dividend. If intercompany loans are planned, or if plans are being made to write these loans off, we would strongly advocate that you get in touch with us first so that the company avoids any unwanted tax charges. The other thing that's on here is life assurance payments. These can be tax deductible, and I just wish to quickly mention, if they are structured correctly, it can avoid P11D benefits for business owners. And just mention that children can work for a parent's company and the costs are tax deductible so long as the work done fairly reflects the level of duties performed. So moving on to the next slide, which is losses and group relief. A company can look to plan for this effectively, and it's important this is done right to maximise the tax savings available. The main type of loss that is relieved is a trading loss, and these losses can be carried back, set against other profits, or carried forward to profits in future years. And it's important to mention as well that loss relief is also available for other types of losses made by a company, whether that be on a property or interest expense exceeds interest income. But these sometimes need checking because they're not so flexible as trading losses. For instance, property losses cannot be carried backwards. Losses can also be offset against any chargeable gains made by a company. But losses made on any chargeable disposals made by a company, so say if a company sells a property for less than it bought it for, those losses can't be relieved against any other taxable profits. Instead, they have to be carried forward and offset against future gains. So when deciding how to use the losses of a company, care and planning is needed. For instance, if a business owner is looking to carry back their losses, it may bring instant tax relief. However, it may be more tax efficient to carry that loss forward, especially if considering that company is going to pay tax at a higher rate on future anticipated profits. So as a trade-off between cash in the bank now and maximizing tax relief, that's why planning and full understanding of the rules is required. The next thing I want to talk about surrounds the area of group relief. And where companies are in the same group, that is, they are controlled by, they're in the same 75% group, i.e. they're controlled by a common company which has 75% holding in both companies, or one's a trading subsidiary of the other. More options present themselves called group relief, and this allows a loss of one company to be transferred to another company that's making a profit in the same period. Also, companies within the same 75% group can transfer assets over to each other. So, for instance, these are assets that are going to be subject to capital gains tax, chargeable gains, taxed as a chargeable gain. So if company A is, say, looking to sell a property, but company B in its group has got substantial losses brought forward on chargeable disposals, Company A can look to transfer that property to Company B beforehand to make use of the potential tax relief that's available. I just wish to point out that the rules on losses changed in April 17, and you'll often see in some tax computations losses split into pre and post April 17 losses. This is because losses made post April 17 are far more flexible. For example, they can brought forward losses arising after April 17 can be group relieved, and they can be relieved against other types of losses. So trading losses brought forward after April 17 can be relieved against future trading property profits, whereas before April 17 that wasn't possible. The final point in this slide is talking about group relief and how this can be limited. The main reason that group relief will be limited is when, say, the company making a loss does not have the same accounting period as the company making a profit. Relief is only available in full for companies that have coterminous accounting periods. So, for example, a company that has a December 25 year end that makes a loss will only be able to transfer half of its losses to a 75% group company making a profit with a 30th of June year end. So just be aware of that. And also, a key thing we need to point out is that group relief is limited for pre-entry losses. So if a company joins a 75% group and the losses made by the company before it joined that group cannot be relieved against profits made of its fellow group members after it's joined. The group losses made before a company joins a group are like ring-fenced and will only be able to be offset against future trade profits made by that specific company. So moving on to the next slide, I just want to talk about corporation tax reliefs and some of the common corporation tax reliefs available and some of the lesser known ones. So if I'm going to talking about the first topic, capital allowances, you may ask, what are capital allowances? And capital allowances is a very generous form of tax relief, which gives tax relief on expenditure that you typically find in a company's balance sheet or fixed asset section. These are items, it's not for all assets in the balance sheet, but it's for assets that are performing a function in a business, such as plant or machinery. Because planning in this area is essential to ensure you maximize the generous tax reliefs that are available to your company. So capital allowances are available on plant and machinery, but they're also available on other assets such as commercial vehicles, cars, but in much more restricted circumstances, and fixtures and fittings within a building. Now, the most common form of relief for capital allowance is in the form of an annual investment allowance, which gives 100% tax relief on qualifying expenditure subject to an annual limit of £1 million. Now, expenditure that falls outside this annual limit can still get tax relief in the form of an 18% writing down allowance or a 6% writing down allowance, determining what pool it falls into. And items that fall within the pool of 6%, which is special rate items, typically apply to high emission cars or fixtures and fittings within a building. This means when we are allocating our annual investment allowance, we allocate it on qualifying items that would otherwise fall within the special rate pool to ensure relief is maximised in the year of purchase. I would point out an important thing, that cars do not qualify for the annual investment allowance. They just go straight into an 18% or 6% pool. But commercial vehicles such as vans do qualify for the annual investment allowance. So again, we see the huge difference, not just for the employee, but for the company in making sure that they get the classification of their vehicle correct. Buildings are a common thing we see in a fixed asset register, and they do not qualify for capital allowances. But instead, buildings that are constructed or cost of altering buildings can qualify for a 3% structural buildings allowance, which is available on an annual basis. Another provision that was brought in recently is full expensing, and this is very useful because it can give a further 100% on qualifying expenditure to companies on plant and machinery, which works quite similar to the annual investment allowance. But to qualify for full expensing, the purchase must be made brand new. The item can't be a car, and it can't be used for leasing purposes. So what's the difference between that and the annual investment allowance? Well, we'd still look to claim the annual investment allowance in preference to full expensing, because annual investment allowance items are likely to result in less capital allowances when that asset is later sold on. Another thing to really worth mention is that if I've talked about cars not being subject to the annual investment allowance, but if a company purchases a car that's a pure electric car, it can qualify for 100% first year allowance. This is not part of the AIA, it's annual investment allowance or full expensing. It's something completely separate. Pure electric cars, not hybrid, just pure electric cars can qualify for 100% tax relief on purchase. And this is currently runs up until March 26, but it may be extended further. And a crucial thing to take away with this is the car purchased must be brand new and unused. 100% relief in the year of purchase does not apply on second-hand electric cars. A thing I want to mention as well is sometimes we see companies receive trades or transfer of trades to another companies. This can be businesses. This can be on incorporation, or where one company wants to move its trade to another in the group. Just be careful. You can inadvertently result in a tax charge for the company that's getting rid of its assets or items that were qualifying for capital allowances. But in these instances, an election can be made between the transferor and the transferee to ensure no tax charge arises on the transfer of assets between these two companies. An area now I often see overlooked that I really do want to bring to your attention is when a company purchases a building, please ensure or look into whether an SY98 election can be made, as failure to do so could result in missing out on very valuable amount of tax relief. When a building is purchased, an SY98 election will allocate part of the building purchase price to the fixtures and fittings, and this will allow the purchaser to get tax relief on this portion of the purchase in the form of capital allowances. Furthermore, it may also reduce the deemed consideration for stamp duty purposes, so another advantage. But the election must be made jointly between the vendor and the purchaser, and you may meet some resistance from the vendor because allocating more of the purchase cost towards fixtures and fittings could well increase their tax bill on sale. But yeah, that's just to be aware of. Whenever purchasing a building, make sure this is on your checklist. The next slide I want to go into is research and development tax relief. I'm only going to go into this briefly, but it's available for companies that have made scientific or technological innovations, and these innovations couldn't be easily deducible. We do a lot of this at HWB, and it does provide valuable corporation tax saving to companies. But in an attempt to combat what HMRC has perceived fraud in this area, HMRC have reduced the rate of relief on this expenditure. So what was effectively 24.5% relief is now only 15%. And there's a lot more scrutiny now by HMRC in this area to combat fraud. And if you are ever looking to do R&D work, we'd strongly recommend that you take out fee protection, because even if they just raise a general inquiry, the time costs in dealing with this are very significant. I would also point out that the deadlines need to be adhered to, and there's a lot more admin that's been introduced by HMRC recently to combat this perceived fraud. The claim must be made within 2 years of your accounting period, and if you've never claimed before, you must tell HMRC of your intention to do so within 6 months of your accounting period. Failure to do this can result in failure to adhere to these deadlines, can result in R&D tax relief being denied, even if your claim is totally legitimate. And the next area, which is slightly connected to this I want to talk about, is patent box or patent box relief. And this is largely unknown, but if done correctly, it can provide useful tax savings to a company. In short, taxable profits that are derived from a qualifying patent are effectively taxed at 10% instead of 25%, which is a substantial reduction. To qualify for this relief, a company must own a patent that it must own a patent from which the sales are being derived, and the patent must have been granted from a qualifying patent office. And care is needed in this area because the UK is a qualifying patent office, but not all overseas patent offices would be eligible. Not all patents granted from all overseas patent offices will be eligible for this relief. And as well, the company has also got to be involved in the development of the patent. So if you are thinking of developing a patent, or you have got sales from patents you develop, do let us know, because it can result in very useful tax savings for the company. So that's the end of this section, where I've just talked about some areas of corporation tax relief which can be quite significant. The final section I wish to talk about are areas to watch, areas of misunderstanding we've commonly seen in the area of corporation tax. And the first one I want to talk about is loans to participators. So when a participator, now this is typically someone who is a controller, someone who controls a close company, such as, and this is commonly directors, when a participator's loan account is overdrawn at the end of the accounting period, the company could face a tax charge. Now, when we go on to going on to the next slide, this is called S455 tax, and the company will pay tax at 33.75% on the value of the outstanding loan. So if we could have the next slide, please. If the individual makes repayments within 9 months from the end of that accounting period the loan was issued, then the amount accessible to tax could decrease. So say if you got a 31st December 25 year end, and an individual has a loan owes, say, to their company £50,000, if they repay that loan, say, by March 26, then no tax will be due. However, if repayments of the loan are made after 9 months in a later accounting period, then the company could be at a tax disadvantage, because it's paid 33.75% on the value of the loan due to it. And repayment of that tax does not happen as soon as the loan is repaid. In fact, it's delayed to after 9 months after the accounting period in which the loan repayment's made. So please be aware of that, because it can have significant cash flow disadvantages. Bear in mind also that if a director owes or an employee owes a company an amount over 10,000, a benefit in kind charge will be due, and it's based on the official rate of interest for HMRC at 3.75%, less any amount of interest paid by the borrower. So as well as having the company having an S455 tax charge, the individual taking out a loan could have an income tax charge to pay on what's called a cheap loan benefit. Now, in this area, I'm not going to go into huge detail, but there are anti-avoidance areas surrounding loans that are repaid but are then quickly taken out again in order to avoid the tax charge. In short, HMRC could look to link the loan repaid to the new loan taken out, thus denying the S455 repayment. So if I took out a loan and I then repaid it within 9 months, but it was always my intention to retake the loan out again a few months later, HMRC could see them as linked and thus keep the S455 charge in place. Be careful if you're going to write off a loan that's overdrawn, because whilst it creates an S455 tax repayment and gets the money back to the company, the loan written off will be subject to income tax at the dividend rates, plus national insurance will be due for both the employer and the employee. And be careful when family members as well, or family members of the company owners, take these loans out. HMRC will link the loan back to the company owner, so all the charges I've mentioned will just be in place. So for example, a business owner's spouse takes out the loan from the company instead of the business owner, everything I've mentioned will still remain in place. One of the things I want to talk about briefly is ATED, which is annual tax on envelope dwellings, and this applies when a company purchases a property worth over £500,000 or more. It will need to make an annual return to HMRC, and tax will also be due. So for example, if a company owns a property worth £500,000 but less than £1 million, it will need to pay to HMRC £4,450 every April. However, companies often own properties worth over $500,000, but they're used for a qualifying purpose, such as letting them out commercially or used as part of a property development purpose. If it's used for one of these qualifying exemptions, then no tax charge will apply. But an ATED return is still due with HMRC by the 30th of April at the end of each year, even if one of the exemptions applies. So make sure you keep on top of your filing requirements. I would also just mention in this area, HMRC are looking at anti-avoidance measures where companies are claiming they're letting out properties commercially but always making a loss. HMRC may deem that the commercial lettings exemption should not apply. So moving on to our final slide, which is to talk about other areas to watch. I just want to mention, I've alluded to this before, but remember, interest is always charged on late payment of corporation tax. This is 8.5% for the normal payments and 7% for quarterly instalment payments. But do note that late payment interest charges for corporation tax are deductible when calculating the company's profits. This concession, though, does not apply to other late charges levied by HMRC, such as pay-as-you-earn interest charges. They are not tax deductible. And the next topic line that's been brought up is assets purchased on hire purchase. These items, providing a hire, are eligible for 100% capital allowances. But for tax relief to be available in the year a hire purchase agreement is entered into, the asset needs to be brought into use by the business in the same accounting period. I've alluded to this before for R&D, but fee protection cover is essential. We do offer this, and it covers our costs in the event of HMRC ever raise an inquiry. For some inquiries raised by HMRC, these can be quite time consuming, and it can be a useful cost saving measure that we would recommend. The next item is double tax relief. And if your company is trading in another country, always review the double tax agreement that the UK has in place with that nation. This is because if it's done properly, it can ensure the correct tax relief is given on any tax paid overseas and vice versa. And in addition, in some cases, a treaty in place will mean that tax is due in only one country. And if this is administered correctly, it will help the company from a cash flow perspective without meaning it'll have to go back to a certain tax authority to reclaim tax that's been incorrectly paid. So always worth taking a look. Finally, I mentioned company structure. For some companies, operating as a company may no longer be the best option for them. It may be best to operate as a partnership. It may be more tax efficient, and also it can cut down on admin and filing requirements. So always review your business structure to see if it's most appropriate for you now. And the final point is amortization. This is typically disallowed in the tax computation for items such as goodwill on the whole, but do note in some circumstances amortization expenses are allowable. Don't always assume it's disallowable. Amortization can be allowed for intangibles that are linked to registered trademarks, patents, and website development costs. So always review your intangibles and don't just assume it's don't always just assume it's goodwill and disallowable. Always review the assets within your intangibles because there may be some allowable elements within there. So, in summary, to finish, we would say, in conclusion, it's always worth having a meeting to review your company's tax position. Rules and circumstances change in the world of tax. We've seen so many changes in the last year, and what was correct for one year may not be appropriate for the next tax year, and your circumstances may change, which means different plans and different action plans may be required. We would always recommend you strive to pay your tax liabilities on time. Otherwise, interest and penalty charges will accrue. If these charges can never be met, don't bury your head in the sand. We would highly recommend that HMRC are contacted beforehand to maybe arrange a time to pay arrangement. This is so that HMRC are aware of this situation before they contact you. As I said, I've mentioned fee protection cover. This is something we would highly recommend, and if you are interested, do let us know. Look out for reliefs available. Reliefs I mentioned, such as patent box, group relief, R&D, and be aware of the timescales, because if you look into this too late, despite being totally eligible for the relief, if the time limit for claiming it is too late, you miss out. And always be compliant. Always make sure deadlines are adhered to. It just makes life a lot easier for a company, and it will save a lot of time, admin costs, and hassle in the long run. So that brings an end to the presentation. I was just wondering if there are any questions. Feel free to type them into the meeting chat, and also my contact details will be on the next slide. And so feel free to pop me an email, or any of us an email, with any further questions you may have about this or any other corporation tax matters. So that just leaves me to say thank you for attending this webinar. We hope it's been useful to you. Just to remind you, we will be emailing round a copy of the slides, and a recording of this should be uploaded within the next week. And we will be issuing feedback forms, and please can you arrange for this to be filled in, so it'll help us with future presentations. So once again, thanks everyone for your attendance, and hopefully see you again sometime. Bye.